Welcome to Podkey Weekly News, where the week's biggest risks get the shortest useful briefing. The immediate pressure points are easy to spot: a choke point for global oil, shrinking U.S. interceptor stockpiles, and an AI boom pulling in $500 billion financing before the rules are settled. Across all three, the pattern is the same. Capacity is tight, leverage is shifting, and the people trying to buy time are running out of easy options. Iran is tying any reopening of the Strait of Hormuz to a long list of demands: sanctions relief, reparations, U.S. force withdrawals, an end to the blockade, and other concessions that U.S. and Gulf officials see as maximalist and politically timed. Why it matters is simple. Even an effective partial closure is enough to reprice risk across energy markets, and Brent has already traded up into the mid-80s to around $90 a barrel at points. Gulf states are looking for alternate pipelines and routing, while Washington is publicly talking up naval control and privately searching for diplomatic off-ramps, including a possible Iran-Oman transit arrangement. What to watch next is whether there's a narrow transit deal instead of a real settlement. That could move some cargo, but it would still leave the core legal and security disputes unresolved and vulnerable to hardline IRGC obstruction. The U.S. has reportedly fired roughly 1,500 Patriot interceptors since the war began and is down to an estimated 1,700 left globally, about half of pre-war levels. That forces commanders into rationing. They can't cover everything, so they're choosing which high-value sites get protection and which don't. This is not a quick manufacturing problem to solve. Patriot and TAID interceptors take about 2 years to build and rely on complicated domestic supply chains. The Pentagon and Lockheed Martin want to push Patriot output from about 600 a year toward as many as 2,000 by 2030, but that depends on congressional funding and multi-year commitments that still have to hold. The broader risk is strategic. Missiles shifted into the Middle East, and drawn from other theaters reduce readiness in Europe and Asia, which narrows U.S. options and gives adversaries more room to test limits. Investigations into Russian procurement show a mature sanctions evasion system, not an improvised one. A GRU 20th Directorate unit and operatives, including Maxim Vilchenkov, are accused of using airline cover, intermediaries, and third-country routes through places like Vietnam and Sri Lanka. Japanese-made parts reportedly appear in about 90% of examined Russian weapons, which tells you how much supposedly controlled technology is still getting through. The method is familiar. Legitimate-looking firms, machine tools and chips routed through middlemen, invoices handed off, and everyone along the chain claiming ignorance. On the financial side, startups such as A7 reportedly handle around 20% of Russia's foreign trade payments, roughly $100 billion, using crypto, yuan settlement, shell companies, and fake invoices. The practical takeaway is that sanctions can raise costs and friction without producing lasting isolation if a parallel logistics and payments ecosystem is allowed to harden. Ukraine's deep strike campaign keeps expanding the battlefield into Russia and Crimea, hitting fuel, electricity, water, logistics, and export infrastructure. Kyiv says it struck more than 200 Russian ships in a month, and whether or not every count holds, the campaign is clearly forcing Russia to spend resources on rear area defense and disrupted transport. The complication is spillover. Russian retaliation has hit Ukrainian grain shipping, and Washington is worried about attacks touching third-party tankers and broader energy markets. That concern is no longer theoretical. U.S. diplomacy has reportedly asked Ukraine at times to pause strikes connected to tanker traffic using the Caspian Pipeline Consortium terminal to avoid harming allied commercial interests. So the next phase to watch is the balance between military payoff and economic blowback, especially if maritime targets start colliding more directly with global energy flows. AI financing is scaling fast enough to outrun the governance debate. NVIDIA is reportedly working with Apollo, BlackRock, Goldman, and others on financing that could reach roughly $500 billion for AI infrastructure. At the same time, investors are pushing huge valuation expectations onto model labs. Anthropic has been discussed in speculative terms around a potential multi-trillion-dollar IPO path, while DeepSeek is cutting prices and weighing a Shanghai listing. The business pressure underneath all of this is straightforward. Cheaper Chinese open-weight models are compressing prices, which is pushing U.S. labs toward open releases, licensing, and a harder search for enterprise products that actually make money. Meanwhile, the safety side is lagging. Labs want industry-led safety bodies and lighter touch regulation, but they also have obvious conflicts of interest in writing the standards that govern them. And the misuse cases are getting more concrete. Chatbots echoing political talking points, destructive scanning of books and proprietary data for training, and reports of suspected China-linked attackers using AI agents to map and probe government systems. The key thing to watch is whether regulation lands on model access, compute, export controls, or infrastructure siting, because those choices will determine who can build at scale and how expensive compliance becomes. A related AI story with real consumer impact is therapy and emotional support. About 75% of therapists report patients disclosing chatbot use, and startups like Slingshot say their tools show clinical scale improvement while moving toward paid subscriptions. The demand is real, but the guardrails are thin. General-purpose models are not licensed clinicians. Mandated reporter obligations are inconsistent, and many company-backed studies are proprietary or not peer-reviewed. Experts are drawing a narrow line here. AI may help with low-stakes support like reframing stress, quitting vaping, or keeping someone organized, but it remains unproven and potentially dangerous for severe mental illness. Given active lawsuits alleging harms, including suicide-related incidents, expect more pressure for clearer liability, disclosure, and clinical standards. In the U.S. economy, headline CPI cooled slightly to about 3.4% in July from 3.5%, helped by lower gasoline, and core inflation eased modestly too. That gives the Fed some room, but not comfort. Inflation is still well above the 2% target, and energy volatility tied to the Iran conflict could reverse the recent relief fast. Fed officials are split on how ready they should be to act, and softer labor signals have reduced market expectations for another near-term hike. The market consequence is visible in cash. Retail money market funds now hold more than $3 trillion of individual investor cash, near record highs, because people still prefer liquidity and safety while yields remain attractive. Wealth managers want that money moved into bonds or private assets, but clients are resisting complexity, illiquidity, and higher fees, especially when inflation is still eating purchasing power. So watch rates, gasoline, and any fresh Middle East supply shock. Those are the clearest triggers for whether cash starts moving back into risk assets or stays parked. One more place where AI meets the real economy is data centers. Massive new financing and backlogs, including more than $100 billion reported by CoreWeave, are accelerating the build-out. That is colliding with local concerns over water use, grid strain, and land use, and lawmakers are responding with ideas like a data center Bill of Rights focused on transparency and community consent. This matters because the AI race is no longer just about models. It's also about electricity, substations, cooling water, and whether companies help pay for the grid upgrades their demand requires. That's the week's shortest useful map of the big pressure points. You've been listening to Podkey Weekly News. This episode was generated by Podkey. Create your own at podkey.fm.